Realty Income is one of the most popular REITs in the world. And this is largely because it has managed to pay a growing monthly dividend for over 20 years in a row. Just recently, the company released its full year results for 2022, and it also issued its guidance for 2023. And this has led many of you to ask me whether now would be a good time to buy shares. Hey everyone, this is Jussi. I run an investment firm that specializes in REIT investing, and in today's video I'm gonna give you the good, the bad, and the ugly about Realty Income's latest results. So let's start with the good. Realty Income had a very good year in 2022. They managed to grow their FFO per share, which is essentially their cash flow, by nearly 10%. That's very impressive for Realty Income. Typically they are really happy if they manage to grow by close to 5% in a single year. They had such a good year because they've been able to source very large and accretive acquisitions in the recent years. First they merged with reit, which is still yielding some benefits today. Then they recently acquired a major casino called the Encore in Boston for close to $2 billion. They also acquired a major portfolio from a company called CIM Real Estate. And so in total they acquired $9 billion worth of real estate in 2022. That's a new record high for the company, and that contributed to a great year for them. And so now comes the bad. Realty Income's rent hikes are expected to remain below average for the net lease sector in 2023. They have guided for 1.25% rent growth for the year of 2023, and that's despite still living in a high inflation world. Its close peers actually enjoy far faster rent growth at the moment, and this is because they have larger fixed rent hikes in their leases as well as CPI adjustments in some cases. So if we look at EPRT or WPC or Vichy Properties, to give you a few examples, their rent growth is typically nearly 2 times higher than Realty Income, and so this is much better in today's high inflation world. And so now comes the ugly. Realty Income is a lot more dependent on property acquisitions to grow, since it has these relatively small rent hikes in its leases. But unfortunately now it's becoming a lot harder for it to grow externally via property acquisitions. As a result, they've guided for just 1.5% FFO per share growth in 2023, which is not enough to keep up with inflation. And as a result, the real value of Realty Income's cash flow is expected to decrease. Why is it getting hard to grow via property acquisitions, you might ask? And there are 2 reasons for this. Number 1, the company is becoming really large. I'll put a chart on the screen that shows you that their growth real estate book value now surpasses 40 billion. And so what this means is that they have to acquire a huge amount of real estate in every quarter to keep the ball rolling. And this is happening now at a time as there are relatively little transactions happening in the market because of all the uncertainty. And then on top of that, the spreads have now compressed quite a bit because the cost of capital of Realty Income has recently increased as a result of compressing valuation multiples and the rising interest rates. And at the same time, the cap rates of its targeted properties have failed to adjust to materially higher levels. So Realty Income has historically been used to buying properties at a 5 to 6% cap rate, but just recently it issued some debt at the 5% interest rate. So there you can see that there is very little spread to be earned, and as a result, the growth in 2023 is going to be quite disappointing. So the conclusion of all of this here is that Realty Income remains a really good REIT if you're a retiree and you need that conservative monthly income. I think that its dividend remains perfectly safe, no issues with that. However, if you're targeting total returns, in that case, I think that Realty Income remains a poor choice. I think that there are much better options in its peer group. Just to give you one example here, Essential Properties Realty Trust, ticker symbol EPRT, is expected to grow its FFO per share by 5%. So that's more than 3 times the growth rate of Realty Income in 2023, and despite that, it's actually priced at a lower valuation. So EPRT has historically outperformed Realty Income, and I expect this outperformance to continue going forward. That's all I had on this topic. If you want to learn more about what other REITs I'm buying at the moment, feel free to join my REIT newsletter, High Yield Landlord. I'll put a link for a 2-week free trial in the description. And otherwise, please like and subscribe. See you at my next video. Bye-bye.